The stock market is at an all-time record high right now. This has been one of the longest bull markets in history. Of course, we have never seen this much central bank intervention ever before, and even after 10 years, the market is now demanding the next round. We watched how in 2018, 93% of assets were negative, and that entirely coincided with the minuscule contraction of the central bank balance sheets. Without record level intervention and injection of money into the financial system, the darkness will take the light. You came here for the truth, so let me unveil that for you. Today we are going to look at several factors related to the financial system. We're going to talk about the yield curve. We're going to look at the bond market. We are going to look at stocks. I have a lot to show you in a short period of time, so let's begin. Chip stocks fall after Commerce Department bars 5 more Chinese firms from buying US parts, so it looks like the trade dispute is expanding, not getting any better in the actual practical, believable steps. We've heard a lot of talk back and forth. Everything's going to be just fine. Don't worry about it. 90 days. Next week it's going to be done. We are signing the deal today, and then suddenly everything is all thrown out the window. I'm talking about the actual documented facts, and all of those that have added up so far have presented us with a gloomy picture of the relationship between these two countries right now. In the end, there will probably have to be some sort of deal, whether it's for agriculture, whether it's for any of their other issues. But of course, there are many things in their lists between these two countries that need to get worked out, and it may not be done in a short period of time. During this moment, we are going to have tensions. We are going to have an increase in volatility, not the VIX index, but real volatility. So keep your eyes peeled for more info related to the chip makers, as well as all of the firms that have exposure to these two countries doing business. Jim Cramer, the real world is much worse than the stock market indicates. It sounds like a quote from the Money GPS, but even Jim Bear Stearns Cramer is actually taking a page out of the GPS. I literally do not have a company that is having a better quarter. Talking about how this quarter is looking worse than the previous quarter, and of course that is probably the case. We had an extremely good first quarter of 2019 compared to the fourth quarter of 2018, so comparatively it looks better. I'm going to see how this plays out into the next little while. I just found it interesting to see even Jim Cramer talking about that. We are now at a 100% Fed rate cut expectation for July. Are they going to do this? Well, you decide. If you look back last year, fourth quarter of 2018, there was a 80% probability of a rate hike, and things changed very quickly. So you can't believe any of this. There are factors which come in and flip everything upside down. Let's see what occurs. Obviously, most people, the traders, the analysts, everybody top to bottom is really pushing for a rate cut, but we know what that means. If they're cutting rates, something bad is happening. Neel Kashkari from the Fed has this article here right on the Minneapolis Fed website. A strategy to re-anchor inflation expectations. In the FOMC meeting that concluded on Wednesday, I advocated for a 50 basis point rate cut to 1.75 to 2% and a commitment not to raise rates until the inflation reaches 2%. One of the most aggressive rate cut strategies that we've been hearing here, even further than Bullard, who wanted a 0.25 cut. This individual wants 0.5% right off. And why? Because he wants to be sitting at the head of the Fed. Obviously, we have right now a weakening situation everywhere in the world. Globally, we have seen it coming all sorts of different sides, whether we're looking at the PMIs, whether we are looking at other economic indicators. It just shows us that there is a slowdown happening today. All the Federal Reserve can do is basically print money. They can use open market operations. They can do a direct quantitative easing. They could potentially buy shares. They could buy bonds. They could buy toxic assets. Who knows what they're going to do the next time around. They're still holding well over $3.5 trillion. I haven't checked it in a couple months now, but it is definitely over $3.5 trillion. It's somewhere below $4 trillion, 3.5 3.5 trillion. That is excessive. They've purchased so many mortgage-backed securities. They have purchased all kinds of different maturities of debt, and you will see here that they want this party to continue on for the foreseeable future. I'm going to show you a comparison here, several charts to look at. Here you can see the red line, that's the S&P 500, going to new highs all the time. Then you look at the bank index, and there's something very different about these two. As you can see, going back from the peak that we experienced back in early 2018 up until present day, it is down 17.7%, and I believe this was yesterday's numbers. So we can see that it is down significantly, unlike the S&P 500, which is into the positive above the previous high. Bank stocks can often be a leading indicator of bad times to come. Look at this in a previous cycle showing you 99 to 2000. It looked very similar. Things were all fine, they were doing great, and then suddenly the bank stocks took a tumble. But you had the S&P 500 that was up 12%, bank stocks down about 16%. And you saw this continue on for a little while until everything popped and you saw the markets coming down dramatically. The catalyst for these different events, nobody knows until that moment comes. It just happens to ring a familiar bell. Okay, we're looking at the yield curves. I'm going to show you several. This happens to be the 30-year and the 5-year, and it doesn't necessarily need to completely invert going into the negative. There's something that I have watched time and time again where you see this going either completely into the negative or hovering around it, and it's not when it comes down that we have a problem. It's when it's going back up. This is the pattern that I have seen time and time again. When it comes back up, that's when we have an issue. And as you can see right here, that has already occurred for the 30 and the 5. You could see at the bottom here, just showing you the S&P 500, and it gets to this peak right at this moment. We're experiencing the same thing right now, and it happens to really turn around in short order. What is that event? What exactly is going to make it happen? I don't know. I can't tell you that, but the exact same patterns are forming in the technical analysis. This has been a little while. It's not going to happen overnight, but it just shows you that this time and time again is occurring. Just looking at these different wedge patterns, which I'll show you in a second, that are giving us this idea that maybe there is something really going on here. Once it breaks above this wedge pattern, we often see a crisis. Now, the same thing has occurred in the last 2 cycles, as you will see right here. So I'm obviously going to monitor it. I'll compare it to the others here that you can see, the 10-year and the 3-month, the exact same thing. I'm not going to repeat myself, but just showing you that. Looking also at this, the 10 and the 2, same pattern. You break above this line, this wedge pattern, and you have a problem. Okay, the exact same thing occurs, although there are moments in time, as you could see here, where it's not exactly the case, comes back down, but if it stays there for a period of time, often we do see that this happens, yield curve inversion, then it starts to go back upwards and bear market comes in, so on and so forth. Okay, last but not least, the 5-year, the 2-year, same exact situation. Just wanted to show you that also. I just did a video yesterday about the negative yielding debt, and already we have surpassed it. You are looking at $13 trillion worth of global negative yielding debt that has gone past the records, just like the stock market, surpassing it. And why? Because in fact, the traders, the investors, they are freaking out about the stock market going up so far, so fast in such a short period of time that they are willing to buy negative yielding debt as much as they can. That's how crazy things are, because they're looking at it thinking, well, I can lose maybe a 1/4 percentage point here, but I'm quote unquote guaranteed to get that. With stocks, I'm seeing a bubble, I'm seeing the heat. Maybe it's time to just put my money here for now. They're not necessarily selling all of their stocks and going into this. That's the mentality I've seen with the traditional 7 share of Amazon type investor. They think that they see this information now I mean sell everything and run for the hills. I didn't say that, and I know that other individuals out there are not necessarily saying that. You are looking at what happens and tracking the progress. Many people, investors, big investors, hedge funds, portfolio managers, they just reallocate their portfolio. A lot of them are starting to reduce their exposure to equities and so on. Weekly change in negative yielding debt. Take a look at that. We are seeing trillions of dollars simply moving in such a short period of time. It is crazy. And last, just wanted to finish off with this, just to give you an idea of where we were at the year end 2018 compared to now. We have seen the yields dropping dramatically. This is just showing you that in Germany, Netherlands, Finland, so on, we are negative yielding on many of their different types of debt. That's all going to end the video. If you found it informative, please give me a thumbs up. When you give me a like, you are supporting me, supporting this channel and the truth. So I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need. All the details regarding the central banks, regarding interest rates, all about the bonds and the financialization of our world. You can get this in the link in the description if you want the audiobook that's available at themoneygps.com. Wait a minute, don't go anywhere. You got to watch this video. You are definitely going to find it informative. So click on it and I will see you there.